Hey, I'm back. When people come to me to obtain a mortgage, it's very important for me that they understand their financial stability. And financial stability looks like something like this. We already talked about the savings, we talked about the zero bad debt, we talked about the household budget, and today we want to cover the wealth planning. And I have a special guest. Sammy Salek is a financial advisor. I've known him for a while. He's been in business for 10 years, and he's genius when it comes to numbers. Sammy, I will let you take over.
Thank you, Rabih, and thanks for having me. So
You're
today
welcome.
we're going to talk a little bit about investing. And we're going to start off with a few key concepts. So number one, diversify. Diversify your portfolio. You don't want to be in one stock or two stocks or one bond or two bonds. You want to diversify and have multiple stocks and multiple bonds. If one doesn't do well, another one might, right? So diversification is key. Also keep in mind, inflation is not your friend. Right now in your savings account, you're probably earning 0.25% maybe. Well, inflation is actually about 1.5% right now, which means your purchasing power is going down year over year. Another key concept is start early. The longer you wait, the less money you're going to have later on in life. And then understand your risk tolerance and time horizon. Not everyone is the same. Not everyone has the same situation. So we want to make sure your portfolio is customized towards your goals.
So that means basically don't put all your eggs in one basket. Whatever costs you today is going to cost you more later on. So you have to keep these things in mind. And then you diversify your assets. So that's also
absolutely right, Rabih.
Right.
So again, when it comes to diversification, spread your assets, right? You have stocks, you have debt securities, which are bonds, and then you have some cash as well. So you want to consider investing in a lot of different stocks, a lot of different bonds. And of course, you have a little bit of cash there as well.
So basically, when people are worried about if the market will crash, am I going to lose all my money? And the answer is no. You will risk some of it, but then you have other safety cushions, basically.
That's correct.
All right.
And just to give you guys an idea about inflation and purchasing power, the average United States inflation over time has been around 3%. So even at a 2% inflation rate, your dollar now will only be worth 60 cents 25 years from now. So what that means is don't leave all your money in savings because you're not even getting that amount in savings. You're probably getting 0.1 or 0.01 if you're lucky. So investing is key here.
Right.
So I wanted to show you guys the impact of waiting, right? When you start investing. A 25-year-old investing $200 a month, by the time he's 65, will have over $500,000. A 45-year-old that started investing $200 a month will only have around $100,000 a year, $100,000 in total assets. So again, the longer you wait, the less money you're going to have down the road. So start saving, start investing early.
So basically, if you're right out of college and you don't think you need to start saving for retirement, you'll be wrong, because you'll be missing out on maybe $400,000 if you wait 20 years to start this process.
That's exactly right. Start early. That's key. And as I mentioned before, everybody's risk tolerance is different. Everybody's time horizon is different. You may be saving for your kids' college accounts, which you may have a 10 to 15-year time horizon. Whereas if somebody else may be saving for their retirement, which has a much longer time horizon. And as you can see, you can go from conservative to aggressive, right? Conservative is going to be your more short-term. Aggressive is going to be your more long-term. And as history has shown, your worst 20-year returns annualized in history have been about 2.9%. So if you invest over time, more than likely you are going to make money.
Nice.
So the conclusion here is you want to sit down with a financial advisor, outline your goals, and help create a plan to reach your financial goals. You want to invest based on your risk tolerance and time horizon. You want to invest for the long term. Do not try to time the market. We say time in the market, not timing the market. And then also invest in a diversified portfolio, which will increase your chances of success.
Awesome. So as I mentioned, it's important for me that you understand your financial stability, simply because when you have financial stability, your life will get better. So if you have any questions about the topics we talked about today, please reach out to me and I'll be more than happy to answer these questions. Thank you so much, Sammy. I really appreciate your time and joining us today. It means a lot to me.
Thanks a lot, Rabih. Always a pleasure.
All right, have a great one.
You too.